Hello and welcome to the webinar, How to Minimise Personal Income Tax Using Unused Concessional Contributions. My name is Josh Stewart and I'm a financial advisor with over a decade of experience in helping people with retirement planning and superannuation. Before I get started, please note any information you receive during this webinar is general in nature as it does not take into consideration your personal objectives, financial situations or needs. Before making any decisions, you should seek personal financial advice from a qualified financial advisor, such as myself. Before I jump to the main topic of this webinar, I'm going to mention some recent news and investment performance update. I will cover how unused concessional contributions work and look at some client case studies before answering any questions you may have. Please feel free to add any questions in the webinar as we go. Recently, new research from the Super Members Council of Australia came out, countering claims that Australians are not spending their nest eggs. 80% of men and 90% of women have no superannuation savings left when they reach life expectancy age. Why is this important? We are living longer, but we all still want to retire early. Longevity risk, that is the chance of living beyond your retirement savings, is a major concern for your retirement. It is not uncommon for me to be dealing with clients in their 90s who have parents that are in their 90s. I will be running a webinar on the 28th of March looking at annuities to support retirement. The report also found that debt in retirement was also increasing. More than 40% of workers retire with mortgage debt. That's up from 16% 20 years ago. And of these, 33% of couples would exhaust their entire super balance to pay it off. Home loan debt is a key risk for your retirement planning, and adequate planning should be taken early to ensure your debt is paid off at least 5 years before retirement. 10 years before retirement is a lot better time to aim for. We're not as concerned with investment debts, but having personal and home loan debts cleared early allows you to bring forward your travel plans, thus being able to avoid or at least limit the large lump sum withdrawals from your superannuation savings. Whenever someone takes a lump sum out of their retirement savings early into their retirement, they're not just withdrawing the 50,000, 100,000, maybe 200,000. What they're withdrawing is what those funds could have generated, the earnings over the next 30, maybe even close to 40 years. It can also reduce the risk of being unable to work up to your desired retirement age. I've seen many cases over the years where clients haven't been able to work those last few years before retirement. And sometimes these years were vital for them to be able to maximize their retirement savings. We will be able to pump more money into superannuation after strong wages growth triggered the first increase in the contribution limits in 3 years. So the concessional contribution limit is increasing to 30,000 per year. And with it, the non-concessional contribution limit, which is set at 4 times the concessional limit, increases also. This will also allow us to add a further 30,000 for those looking to use the 3-year bring forward rule next year. But note, if you have already used the bring forward rule in the last 2 financial years, you won't be eligible to contribute the additional bring forward amount. Performance update for January. So a modest rebound in global bond yields led to a flat outcome for defensive assets, although growth assets continue to produce positive returns. The main theme over the month was the scaling back of near-term US official interest rate cut expectations, just giving ongoing solid US economic growth, signaling from the Fed Reserve officials. Financial markets are still anticipating multiple US interest rate cuts late this year. And in Australia, a lower than expected December inflation report and weak retail spending over the quarter also affirmed those expectations that the Reserve Bank would start to cut interest rates later this year. I typically separate client investment preferences into 4 options. Those are low-cost index investments, industry super, active investments, and also ethical investments. So this table shows you some of the investment options I use for these, although many clients also have exposure to direct shares, term deposits, and investment properties. We can see that ethical investments performance has been very strong over the last year, whereas the industry fund have struggled. Looking over the 3 years, having that exposure to active investments has helped just in navigating that changing interest rate environment. The term deposit rates have been falling over the past 6 months, in line with the market sentiment that interest rates will likely be cut in the future. So current 12-month deposit term deposit rates are 5.1%. For our call accounts, we still favour accounts like the Macquarie Accelerator, as you're not penalised for withdrawals or required to deposit a certain amount each month. But that interest rate has fallen to about 4.65% just recently. I am still seeing a few investors selling investment properties in favour of term deposits. If we consider rental yields of say 5%, less fees of approximately 2%, excluding any debt on the property, your net income's about 3%. So term deposits over 5% is appealing for those more income-focused investors. Getting into the main content of this webinar, I first want to explain what concessional contributions are. So concessional contributions is the money that you or your employer put into your superannuation fund before tax. They're also called before tax contributions or pre-tax contributions. Concessional contributions are taxed at a lower rate of 15% in your super fund, which can help you save on the income tax, which we'll be going through further in this webinar. However, there is a limit on how much concessional contributions you can make each year. Again, that current limit is $27,500 per year, but it is going up 1 July to $30,000. If you do go over this limit, you may have to pay extra tax. Unused concessional contributions are the amount of money that you can contribute to the superannuation fund before tax, but did not use in previous financial years. So you can carry forward these unused contributions for up to 5 years and use them just to increase your superannuation balance and reduce your tax liability. However, you can only do this if your total super balance is less than $500,000 at the end of the previous financial year. This makes it very important to plan correctly, as leave it too long and you may miss out on this valuable tax deductible contribution. To give you an example, current concessional contribution limits $27,500. So if you had contributions of $15,000 last financial year, you would have had $12,500 unused carry forward contributions that you could have made in this year, bringing your total this year $27,500 plus that $12,500 to $40,000 that you could have dropped into that super fund, just as long as your super balance was below that $500,000. So the benefits of using the unused concessional contribution cap strategy. The main reason that we use it is reducing your tax bill. So concessional contributions are taxed at a lower rate than the individual's marginal tax rate. This can result in significant tax savings, and those catch-up contributions or unused contributions can help take advantage of that tax benefit and just reduce your overall tax. So unless your income is below $18,200, the super tax rate is lower than your personal marginal tax rate. Typically over $45,000 per year is where you start to get the larger tax savings. If you're earning over $180,000 a year, then you're potentially saving 32% on every dollar you're able to contribute to super concessionally. We will discuss in more detail later, but if your income and superannuation contributions is above $250,000, you will have to pay an additional 15% tax on your super contributions, known as the Div 293 tax. But note, this is only payable on the amount above the $250,000, and you are still better off than paying at your marginal tax rate of 45 cents in every dollar, plus that Medicare levy of 2%. So you can see that there are some large tax advantages to contributing more into super, but it does get better. Consider the longer term benefits of compounding. Superannuation offers a low tax rate environment where earnings are taxed at a maximum rate of 15% and 0% once a pension is commenced. This can be very tax effective compared with investments held outside of superannuation, where tax is paid at your marginal tax rate. The more of your wealth that you have saved in superannuation, the better it is going to be for your long-term wealth creation. Unused concessional contributions can help you boost your retirement savings, particularly if you've not been able to contribute the maximum amount in previous years. By making additional contributions, you can maximize your superannuation balance, increasing your retirement income and decreasing the tax you pay over your life. Let's look at a quick example of the tax savings of just investing within superannuation. So let's consider a couple, both 40 years of age and earning $100,000 each per year. They've got a $500,000 investment portfolio. That would see them pay $2,181,467,000 cumulative taxes by the time they retire at 65. Okay, versus the bottom strategy is if we were able to contribute that $500,000 to the superannuation, based on the same earnings and exactly the same fees, their cumulative taxes would fall to $2,058,478. That's a saving $122,000. And we haven't even included any tax savings that they may have been able to claim by contributing the funds to super in the first place. So what are the other factors to consider before using the strategy? The drawbacks of using the unused concessional contribution cap, of course, you're going to expose your money to market risk and fees. So depending on how you choose to invest your superannuation, inadvertently, you're going to take on some investment risk. Depending on the super fund you choose, your investments could be the same as if you're investing in your own name, and only for a slightly higher administration fee. The bigger worry is around dud super funds. So whenever we consider adding more funds to superannuation, it's important to review your fund and the underlying investment options, making sure they're appropriate for you. Locking your money up in superannuation. Superannuation is subject to preservation rules and cannot be accessed until a condition of release is met, such as reaching a preservation age and retiring. Typically, that's after 60 tax-free. Division 293 tax is an additional tax on super contributions, and it will reduce the tax concession for individuals whose combined income and concessional contributions is more than $250,000. So the Div 293 tax is charged at 15% of the excess over the threshold or the taxable super contributions, whichever is less. It's important again to note that your marginal tax rate at that level is $45,000 plus 45% plus 2% Medicare levy for that income over $180,000. So 47% versus the 30%, your normal 15% super tax rate plus an additional 15% Div 293 tax, you're still 17% ahead of where you would have been. Let's look at some case studies. So first case study is the sale of investment property. So a client had already ceased working the year prior, and he had some minor issues with the tenant in his investment property, but more importantly, he wasn't happy with the rental income that he was receiving versus the increasing term deposit rates at the time. So he decided to sell. The client had already sold the investment property before he sought my advice. He was looking at a large tax bill as he had a realized capital gain of $231,000 on the property. The recommended personal deductible contribution maximised his concessional contributions up to his cap for the year, the $27,500, and also used his available unused concessional contributions of $72,500. That allowed him to make $100,000 personal deductible contribution into his super fund for that year. So let's look at the benefits. So his assessable income reduced by the amount of the deductible personal super contribution. We can see here without the deductible contribution, he would have been looking at tax payable of $28,004 plus Medicare levy of $2,310, so $30,314. By making that personal deductible contribution of $100,000, his net tax payable fell to zero. And it's important to note that's his personal income tax that he had to pay. Once that 100,000 hit the super fund, it would have had to pay the 15% tax. So his net tax saving after accounting for that 15% tax in the super was 15,314 for that financial year. Let's look at another case study with a higher income earner. There's a higher income earner with surplus cash flow and savings. Their objective is to build long-term wealth and minimise personal income tax. The recommendation was to make a personal deductible contribution of $50,000 into the super fund. That would be using the current year concessional contributions, his remaining limit over his employer contributions of about 8,300, plus his unused concessional contributions of about 41,600. So the benefit, he was able to reduce his personal income tax, as shown by the table below. We can see without the personal deductible contribution, his net tax payable would have been $55,267 for the financial year. After including the 50,000 deductible contribution, we lowered his taxable income to 130,000, which resulted in as a personal income tax of 35,767. Now, again, we must factor in the 15% tax when that contribution hits the super fund, but his net tax saving would have been $12,000 in that first financial year. Thank you again for your time. I will send an invite out for the annuities webinar that I mentioned earlier. If you have any questions, please feel free to put them in the chat. Thanks for your time.